Good morning, everybody, and welcome to our monthly IFRS webinar series. This morning, I have with me Kevin Frobus, as always, IFRS partner in Sydney. So good morning, Kevin.
Good morning, Aletta, and it's nice to see you again at the start of our 2021 year, all bright and bushy-tailed from Melbourne. Hello, everybody, and welcome to our program for the year.
Absolutely. Even as a South African, Kevin, we can celebrate Australia Day, which we've done yesterday with a lot of friends over. And I said to them, the one thing I know about the 27th of January, it's full on back to business, all right? So here we are back to our monthly webinars as well. Lovely to see you. I also have with me today a new regular presenter, and that is one of our IFRS advisory partners based in Perth, Ashley Woodley. Now, Ashley is slightly different to Kevin and I in that she's also an audit partner. So not only are Kevin and I on the East Coast, she's on the West Coast, but the two of us are just IFRS nerds, and she's got an extra hat as being an audit partner. So Ashley, I might throw over to you to introduce you for our first webinar. Welcome.
Thanks, Aletta. Good morning, everyone, and good morning, Kevin. All right, so a very quick introduction about myself. As Aletta mentioned, I have over 15 years experience in audit and assurance and also in IFRS advisory. And being here in WA, I have a depth of knowledge in the natural resources and mining services industries, as well as a focus in the not-for-profit sector. So hopefully with the natural resources experience and also my role in audit, I can bring an added area of expertise to these already excellent webinars and hope that it's relevant for many people on the line.
Thank you very much, Ashley, and thank you very much for joining us and putting your hand up to join us on a regular basis. Kevin and I are really excited to have somebody else join us. And I'm sure that all our clients will be really happy to hear from you and all the wisdom you bring. And then the fourth person we have today is a guest presenter, Travis Maddox, who is an R&D partner in Melbourne with me. And you know, before I get to Travis to introduce himself and talk about his passion, you know, our agenda today is around asset acquisition versus business combination. And we'll talk about the latest amendments that's been made to IFRS 3. However, when we asked board members and finance teams last year to complete our six clicks financial reporting risk review, we found out that there's one thing that boards and finance teams have in common, and that is their number one priority, as established last year in this review or a survey, is cash. So absolutely cash is king. During COVID in particular, cash is king. And when we speak to clients, they've been telling us there's so much pressure on cash, and it's obviously important to them. It's been the number one priority for boards and finance teams. So I had that at the back of my mind, and then I listened to Travis here in the Melbourne office, and he was talking about that across Australia, you know, companies are missing out on cash because they don't understand the grants and the incentives that are available to them. Now, I just heard that and I said, okay, Travis, you have to come and talk to our clients and tell them about this, because they are telling me they're interested in cash. You can address the problem. So at this stage, Travis, I'll hand over to you and you can talk about your passion.
Great, really appreciate it. Thanks, Letta, and thanks for inviting me along. And great to speak to you all today. Cash is absolutely king. I think no more so than in this environment of COVID that we happen to be in. You know, the pressures that businesses are facing in this environment just means that cash is something that we really need to get hold of really quickly. And I think my experience has shown me that almost every client that I talk to, whether it's an existing client of mine that is accessing the grants and incentive programs that I'm introducing them to, or whether it's a brand new client, It's very rare that everyone's accessing every available cash opportunity, and some are just so easy to grasp onto and can drastically change businesses' directions in allowing them to open up the doors, really, and to access huge amounts of cash. We're talking millions of dollars here that are left on the table because companies just don't understand that they actually do qualify and can access these particular incentives. Now, one of the particular programs, there are a lot of government grant programs that are around, and my team, myself and my team assist in accessing those programs. But the one that I really wanted to focus on today, just in this short time that we've got, is the R&D Tax Incentive Program. Now, some of you may have heard about this before. Some of you may have even claimed it in the past. And maybe you haven't heard of it before, but this is the government's principal program to incentivise companies to invest in innovation. They invest $3 billion every single year in allowing companies to access cash through this program. If you're not one of the claimants of this program, then you're missing out on cash because your competitors likely are claiming it. This is not a grant program. It is purely an incentive program, such that if you tick the box, you're guaranteed to get the cash back. And huge amounts of cash on the table. It's unlimited unless you're spending more than $100 million in a year, but basically unlimited in the huge amount of cash that you're entitled to. And it's applicable to all industry sectors. A lot of people hear the word R&D and they think, we don't do R&D. We're not wearing white lab coats. We're not, curing cancer in a laboratory. But if you're improving your processes, if you're changing your processes, if you're improving or developing new products, or maybe you're just even developing new or improved software, that can be something that may qualify for this program. And maybe I'll just flick back, if you don't mind, a letter onto the previous slide, just still. Basically, you can be entitled to up to 43.5 cents back for every dollar that you spend. So if you spend $1 million, and I know that sounds like a lot of money, but very quickly, if you start thinking about the money that you spend on projects, small projects, even things that you don't even consider a project, you're just upgrading your IT system. You're just improving a process, changing things, the way you do things. All of the cost that's involved in doing that, you could get up to 43.5 cents back in cash. And that's every single year we can claim this. So we look back at what you've done over the past year, look back at the 2020 year that's gone. We had COVID in there, and a lot of people were changing the way they were doing things because of COVID. I had a gin distillery that was developing gin, and they decided, oh, hold on a minute, I'm not sure that we're going to be able to sell as much gin during COVID, so let's change our processes and start making hand sanitizer. And because of that, they can, of course, access the R&D Tax Incentive Program through looking at some of their new processes in developing hand sanitizer. They quickly realised that actually people need gin during COVID and probably needed it even more so, and actually changed back from hand sanitizer back to gin. But nonetheless, during that process, they realised that they could claim the R&D tax incentive on both those changes, the changing to hand sanitizer and the changing back. They had IT systems that they needed to improve through the ordering process. And again, that was all qualifying. That's part of their business as usual process, really. But they're now getting back hundreds of thousands of dollars that their competitors actually probably aren't claiming and aren't accessing. So I really encourage you all to relook at this program. It's open to every single company. So as long as you're a company, unfortunately not available to non-for-profits, but outside of that, any industry sector, if you're doing something different, new, unique, doesn't have to be world first, this could qualify and you could get some cash back. And on to the next slide, just to give you an example of some of the current claimants of this program. It's broad. It's open to so many different industry sectors. There's some classic ones that you think, yeah, sure, that makes sense. Life sciences, they are developing vaccines, the COVID vaccine, and etc. But most manufacturing businesses, if they're not claiming, should be claiming. Every engineering company, if it's not claiming, should be claiming. IT and technology, whether you're dedicated in that space or just simply doing it as part of your broader business processes, just simply improving an IT system may qualify, get you some cash back. And as I say before, this is not a competitive process. Simple as putting in an application, and obviously our team can assist with that, calculate the eligible cost, get some hard-earned cash back. And this is what the government's trying to encourage businesses to do, is to do some different things. Don't do the standard business as usual that I've always been doing. take this, a journey here, do some innovative things, and be rewarded for it. But one great thing here, and this is where I find a lot of businesses don't realise, is that the biggest bucket here, as you can see on here, the biggest circle, is actually services. So if you're in any sort of services industry, be that professional services, be that engineering services, any sort of services really, you can see that this is actually the biggest bucket of claimants. And often it's not one that you would traditionally think as doing R&D, but they very clearly are. So I'd really encourage a lot of you to actually rethink whether you might be qualifying for this and potentially other grant programs as well, because there's so much cash available if you just simply ask the question. Am I doing anything new or different? Am I changing my processes? Am I developing new or improved products? So I'd really be keen to actually, now if you don't mind, Aletta, if we can do a quick poll to actually understand whether businesses are actually developing new or improved products, processes, services, devices, or even IT systems. So I'd be really keen, if you wouldn't mind right now, just a quick yes, no, or unsure, mentioning whether you yourselves as a business are actually developing new or improved products, processes, services, devices, or IT systems. And if so, just click that yes button. And maybe you're not. Maybe you've been doing the same thing for the last 50 years, in which case it'd be very unusual, but nonetheless, I'd be interested in understanding that and by seeing the poll here. So I'll give you just a short amount of time, if you don't mind just responding to that one, and then I've got just a final follow-up poll, and I'd be interested to see what the results are of this one. Probably
Travis, so even under COVID, if we are doing something different as a result of COVID, or we've changed our process as a result of COVID, that's still applicable, right? It's still fair game here.
Absolutely, yeah, absolutely. So you changed the way you do things because of COVID. So I know a lot of businesses unfortunately had to put off staff, and that's not a great thing, or redeploy staff into different areas. But that often means that they're running their processes in a different way because they can't use the same amount of staff they were previously using. Or it could be simply that redeploying the staff into a different area to allow them to be fully utilised means that you need to develop a new process. Change the way you are doing things. That may equally qualify in this program. So we're not talking about world first curing cancer necessarily, but simply doing those things may in fact allow you to get this cash back. So, great program to be re-looking at. Those that are already claiming the R&D program, it's also worth a relook to see whether you're not just claiming the things that are very clear-cut R&D, but also re-looking at those processes that you've changed throughout COVID. Anything that's changed in your business throughout COVID, that may come into this bucket of what we consider R&D for tax purposes. So, yeah. So interesting results here. So interesting to see that roughly 50% here are actually saying that yes, we do develop new or improved products, processes, services, or devices. So the other 50% are saying no, we don't. Maybe we can continue to do things the same way, which is interesting. I would have thought that would have been a bit higher, to be quite frank, but nonetheless interesting.
Just a comment, Travis, is that I'd say about one out of every 4 of my IFRS engagements right now are R&D accounting based, and that is a huge jump. I mean, a year ago there was nothing, so it is happening, and yeah, maybe those people took the opportunity for the cash, but there's no time like the present, and this type of environment is driving invest. And one of the ones I keep getting is cloud computing, transferring onto the cloud. I think a lot of that was actually in the system or planned even before COVID, but it certainly had to sort of tick up when it hit. So yeah, just another example of the one we're seeing.
And that's the thing, everyone seems to be transforming their IT processes and systems to try and stay up to date, and a lot of that could qualify for R&D, and you can get the cash back for it. And that also means that you can potentially recognise that as income potentially on your P&L as well. So it can be a bonus both ways, from a cash perspective as well as from an income recognition perspective potentially. So just got another poll here. This is the final one for me. Is also just whether you actually do claim the R&D tax incentive currently. Or you did previously, or no, you just don't. It'd be interesting to understand that and how that compares to those, the 50% that's saying, yes, we are developing new improved products or processes or IT systems, and comparing that to who's actually claiming currently. So that'll be interesting. So if you wouldn't mind just responding to this last quick poll, and then we'll be interested to see the results in just a few seconds or so.
Travis, I think, you know, first of all, thank you for coming and sharing this with us. I think there's a lot of food for thought. I think a lot of people, we all know we're doing things differently. And if we are doing new processes, I think it would be good to speak to you to find out, you know, to what extent, you know, what are the next steps? How do we try and claim this? I think it's worthwhile. If, you know, I listened to the 3 billion per year and I nearly had a heart attack. That's the investment in innovation. I mean, that's fantastic. I'm just hoping that our clients get access to a big part of the 3 billion per year. So, you know, thank you very much for.
Yeah, no, thank you. And it's interesting that the 3 billion per year is only on this program alone. They spend another 60 odd billion throughout the other government grant programs. So, you know, this is small in the scheme of things, but 3 billion alone is huge, and currently only being accessed by about 13,000 companies. So there's so many companies out there that are just not accessing it. And I think we can see here that, you know, with 21% out of the people responding here in this response, only claiming versus the other roughly 80% that are not claiming. You can see that there's a bit of a mismatch between the two polls. The first one, we had 50% that are improving their processes or doing something a bit different, but yet only 20% are actually claiming. So there's a mismatch there of at least 30%, you would imagine, that maybe they should be having a think about it. And the other one I would mention is that for those that are already claiming the R&D tax incentive program, when's the last time you've had a health check? A simple review of what you're doing, because I've never found a claim yet that's done by another provider that I haven't been able to improve. So that's meant, you know, literally getting more cash back because they've missed out on things or haven't done a detailed enough analysis of their costing, of their expenditure. And often that we can do that quite simply for clients without much effort on their part. So I'd encourage you to all take a few moments, have a rethink about that. Number one, should I be claiming the R&D tax incentive? Or two, if I do, should I be talking to Travis about and his team about, you know, really having a rethink? You know, can we be claiming more? Am I claiming what I'm fully entitled to? Because it's cash is king. So let's, happy to take any calls at any time, and then obviously to talk to people about it. So thanks very much for the opportunity, Aletta, Kevin, Ashley, appreciate it.
Thank you, Travis. I think the other thing that you've said there is a fresh pair of eyes is a good thing. We see it from an audit perspective. You know, a fresh pair of eyes looking at these R&D incentives and claims would be great. So thank you, Travis. I hope we can get some cash for our clients. Thank you for joining us. I thought I'll also link back to what Kevin have just said, because Kevin, you won't believe it, I'm also seeing a spike in this. A lot of people are actually applying. They've been speaking to Travis, and then they say, how do we account for it? And from an accounting perspective, you have refundable R&D incentives, and there are non-refundable R&D incentives. And we've actually, in October last year, in our monthly accounting news, written an article including examples on how to deal with refundable R&D incentives. And in November, we've included an article on non-refundable. Refundable, it's basically a one way on how we account for it under government grants, but a non-refundable, there's basically three alternatives that we see in practice. There's divergence in practice. At BDO, we're not mandating any of those. There might be some that we prefer, but you know, there's no mandating any of those. But I thought, you know, if you're doing R&D incentives and you want to link it back to the accounting, these are two recent newsletter articles that you can have a look at. And then in one of our upcoming webinars, we'll have a revisit this, because at the end of the session, I'll you know, have a bit of an introduction on the scheduled webinars. And one of the things we want to do is go through all the accounting standards and focus on the various practical expedience accounting policies available, and also focus on the life cycle of entities. You know, we're in a growth stage and you're investing a lot as opposed to later on where you might not be investing, although I think Travis will say we have to continue to renew our thinking and our processes. It's not just for startups. I think we'll move on from that, and we'll move on to our topic around IFRS 3, business combinations, and we'll start with the identification of a business combination. And I think before we look at this, when you look at the topic as we've advertised it on our website, we said we're going to look at asset acquisitions versus business combinations. And we'll focus then on how IFRS 3 has recently been changed or amended to help with this decision. But I thought maybe I should start with the why. Why do we contrast asset acquisitions in contrast to business combinations? And the answer lies in how do we account for this. So if you're looking at accounting for asset acquisitions, if it's a normal property, plant and equipment, a normal intangible asset, any asset, real basic asset acquisition, you would consider whether there is an applicable standard for it, because there's one for inventory, one for investment property, etc. But the basic principle across all asset acquisitions would be that if you acquire a group of these assets or a single asset, you shall identify and you will recognize the individual identifiable assets that you've acquired, including intangible assets, and you will identify and separately recognize your liabilities that you've assumed. So if you've acquired a group of assets and liabilities, you will look at them all separately and you will account for all of these assets and liabilities separately. So the cost of the group of assets and liabilities will be allocated to these individual assets, individual liabilities, based on their relative fair values at the date of purchase. Now, the kicker or the most important thing is actually the third bullet point, and that is such a transaction or an event does not give rise to goodwill. That's the critical thing. So if you've got an asset acquisition, no goodwill. If we contrast that to accounting for business combinations under IFRS 3, there's a 5-step process. You know, you identify, so who's the acquirer? It's not always obvious because we could have reverse acquisitions. You determine the acquisition date, but now this is where the fun starts, step 3. You actually recognize and measure at acquisition date the identifiable assets acquired and the liabilities that you've assumed, as well as any non-controlling interest in your acquiree, and you recognize these identifiable assets and liabilities at fair value. So irrespective of what you've paid for these assets and liabilities, you recognize these assets and liabilities at fair value. You also in step 4, you measure the consideration. So what did I actually pay? And step 5, basically the difference between the fair value and what you've paid is either goodwill or it's a gain from a bargain purchase. So the critical thing here is if you acquire an asset, you account for it at cost. If you do a business combination, all the assets, all the liabilities are accounted for at fair value. And that difference between what you've paid and the fair value results in goodwill. So there's so many differences here between the two, completely different ball game actually between the two. So if you ask why are we looking at this, it's because the accounting is so different. And what we are finding in practice, the biggest mistake we're finding is where people are applying business combination, IFRS 3, in situations where it's actually just an asset acquisition, where they should account for it at cost and not recognize goodwill. Or the other way around. But I think most often IFRS 3 are maybe applied too quickly and goodwill booked too quickly. So that's why we thought, we'll have to look at this. But there's another reason, and that is that we've got these amendments to IFRS 3, so it's timely to have a look at this. The other thought as part of the introduction that I thought I'll have a look at is, yes, we contrast asset acquisition with business combinations. And business combinations, we are applying IFRS 3. But I also want to link back to the scope of IFRS 3. I think Kevin and I have said it many times in the past. The biggest issue is actually picking the correct accounting standard to apply, to make sure you are within the scope of a particular accounting standard. Many people, once they know which standard is applicable, can work through the standard and get to the right debits, credits, and journals and disclosures. But it's easy to be in the wrong standard, and there's quite often quite interesting drafting on how they draft the scope. So it's tricky to know which standard is the appropriate standard. And IFRS 3 is no different. Because IFRS 3 says that IFRS 3 applies to a transaction or an other event that meets the definition of a business combination. Okay, sounds simple or not? And enough. Now, IFRS 3 then defines a business combination as a transaction or event in which an acquirer obtains control of one or more businesses. Now, I've put there in different colors control and businesses. It's all about a business combination is where one entity gets control of another business. You're not just getting control over an asset, you're getting control over a business. Now, sometimes we refer to these type of transactions in practice as a true merger or a merger of equals. And they make it very clear here that even if you've got mergers like we had in the old days or true mergers, IFRS 3 says there's been a combination and somebody's got control after we've got the merger. You always have to come up with who obtained control. All right, it's really important. And it's really important to know who's the acquirer and who's the acquiree because it impacts the accounting treatment. If we go on with the scope, they go further and say, all right, so we apply IFRS 3 very simplistically when an acquirer gets control over a business, but they then clarify IFRS 3 does not apply to accounting for the formation of a joint arrangement in the financial statements of that joint arrangement itself. You will look at IFRS 11. The next one is really important. The acquisition of an asset or a group of assets that does not constitute a business. Because remember, you could buy a group of assets from another entity. And the fact that you buy a group of assets doesn't mean it's asset accounting. Those group of assets could constitute a business, and therefore you should be applying IFRS 3. So IFRS 3 is not just when you buy shares in another entity. It could be where you buy assets from another entity, a group of assets. And you have to assess, would that group of assets be a business or not? All right, so it's back to a business. And then finally, IFRS 3 does not apply to a combination of entities or businesses under common control. And this is one that we frequently see issues with. And interestingly, the International Accounting Standards Board are currently or have recently added to their agenda a project on, so how do we account for entities where there's a combination of entities under common control. It's a huge problematic area. If you've got a combination of entities under common control, please contact us. There are many pitfalls, many considerations. Sometimes you do end up back in IFRS 3 and sometimes not, all right? And that's a big area of judgment. But it's not an obvious I'm going to apply IFRS 3 or I'm not applying IFRS 3. So as you know, I like decision trees. So I thought, key considerations before we even start with IFRS 3 or amendments would be, has an acquirer obtained control of a business? If you say no, there's no control of a business, definitely you do not apply IFRS 3. You look at asset acquisition under the existing accounting standards. If you say yes, we have obtained control of a business, your next question would be, are the acquirer and the acquiree under common control? And if you say no, they're not under common control, easy, you apply IFRS 3. However, if they are under common control, you do not automatically apply IFRS 3 or AAS 3. There's no automatic answer. Another set of criteria, judgment considerations would be applicable. All right, so it's not an easy answer. So maybe just a very high level and very simplistic, what is common control? What are we talking about? So if you've got a group with a parent, 2 subsidiaries, a number of sub-subsidiaries, if, for example, subsidiary C obtains control of subsidiary E that was previously under the control of subsidiary B, one would argue that subsidiary C obtained control of an entity that was under common control, because ultimately all of these entities are under the control of parent A. All right, and if we're just shuffling the deck chairs, nothing's really changed, and therefore arguably we shouldn't be applying IFRS 3. We should not be booking any goodwill, because from a group perspective, nothing's changed. So I thought I'll just leave it there. It's a complex area, but be careful for common control.
Aletta, can I just throw some
Yes.
comments in, just to give you a bit of a break as well? But this is a very good introduction in the sense that asset acquisitions, in a way, before COVID were clear. You knew when you were buying an asset, but it is true that since then things have changed dramatically, and so this is very timely. Just a couple of comments on the group reorganizations. We all know, at least in the IFRS world, that if you reorganize your group, for example, in anticipation of a sale or an IPO, you've got to watch this common control issue. But it amazes me how frequently it still comes up. And we are in IPO heaven at the moment. They are coming at us from all directions. So that's just one to remember. Group reorganizations, as Aletta said, there's no definite answer, but because the group is controlling entities and entities in the group are being reorganized in order to anticipate an IPO one day in the future, that's potentially a common control transaction. So just reminding everybody to tread carefully there, because a lot of owners want to see goodwill crystallize on the balance sheet before they IPO. That's like the holy grail, and of course they're disappointed to see that sometimes. And then the last one is, interestingly, we always say that people don't, IFRS people aren't very practical, but I try and break this down, and you will know when you are negotiating the transaction whether you are starting to head towards an asset acquisition or business combination, because the devil is in the thing you're negotiating. If you're negotiating a transaction as a going concern, it's often a business combination. Now, that's also not a hard and fast rule, but it's an indicator. But if you're trying to buy an asset like an R&D asset that's given rise to a pharmaceutical patent, and that's the prize, well, that sounds like an asset acquisition, and it's a good type of indicator. And I'm going to stare at Ashley a bit, because I think I can almost say that the extractive industry has this as well, especially in those in the early stages of exploration. Sometimes you can be acquiring shares in an entity, but that actually hasn't got to the business stage yet, and you're actually buying the tenement or whatever the asset is that you're trying to negotiate. So that's just something is kind of keep in the back of your mind. How do the negotiations go? And it'll start to give you an indication of the risk involved in the accounting.
Thank you, Kevin. So finally, we get to the topic, and that is the amendments to IFRS 3. I thought it was important just to give us a little bit of a background why we're talking about it and why are these amendments so important. So the overview of the amendments, this standard, the original IFRS 3, was actually originally issued in January 2008. So it's been a few years. And they've done a post-implementation review of IFRS 3 and to provide additional guidance to entities to determine if an acquisition is a business or a group of assets. I think in practice, a lot of issues there, and they've decided to make a few changes. The key changes is they've updated the definition of a business. Now, in the first part of this webinar, I think we've clearly articulated that if you start to change the definition of a business, you are changing the potential application of IFRS 3 in a very big way, because it's very critical to know whether you've acquired a business or not, because that determines whether you apply IFRS 3 in the first place. It determines whether you'll be booking goodwill or not. It determines whether you'll be booking assets and liabilities at fair value or not. And then they've added an optional concentration test, which Ashley will explain a bit later. And they've also added some supplementary guidance, including additional illustrative examples. This is applicable for annual reporting periods beginning on or after 1 January 2020, with early application permitted. But what you'll see here, years beginning on or after 1 January 2020, that would have been 31 December last year, and this is now absolutely in play. So we have to look at this very carefully. The amendments, 5 key amendments, we're going to work through them one by one. I'll look at the first few, and then Ashley will look at the optional concentration test, and Kevin will end up with a very good example, and also Kevin will share some lessons learned. As you know, and as Kevin has said, we've been involved in a lot of IPOs at the end of last year, and this has become very relevant, and he'll share some lessons. So if we move to Amendment 1, and that is an amendment to the definition of business and outputs. Now, I've played around with this even since finalizing the slides that went out to our participants this morning, and I've tinkered with it and added some bullet points and stuff. So in the old definition, the focus was on returns. If you define a business, it's an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return. Right, the whole focus on return. Now, the return could be in the form of dividends. In the old days, it could have been lower cost or other economic benefits directly to your investors or your owners, members or participants. Now in the new definition, that last part of the definition has changed, and it says an integrated set of activities and assets that is capable of being conducted and managed for the purposes of, and I've listed them out, 3 bullet points, the purpose of providing goods or services to customers. The second one, generating investment income, so dividends or interest on those investments, or generating other income from ordinary activities. So it's an integrated set of activities and assets, integrated, and they're capable of being conducted and managed for these 3 purposes. All right, so I think the business definition of a business is very clear. It takes the emphasis off returns, but it actually makes the definition potentially a bit narrower. Right, because it cuts out just lowering costs or economic benefits that go to directly to investors. So that's the first part. Now, this change to the definition is critical to assess whether we're in the scope of IFRS 3 or not. Now, they also had to change the definition of an output because it's kind of linked. And previously, the old definition of an output was the result of inputs and processes applied to those inputs that provide or have the ability to provide, again, a return in the form of dividends, etc. And now they said in the new definition, the result of inputs and processes applied to those inputs that provide goods or services to customers, generate investment income, or generate other income. So what is an output? It is a result of inputs and processes. Apply to those inputs and it results in these things. So a new definition of a business and an output and important changes. Now the second amendment kind of flows a little bit on from that around outputs because there are amended guidance on inputs, processes, and outputs. And again, it's got an important consequence. So we know that the elements of a business is an input and a process that has the ability to contribute to the creation of an output. So this is the new guidance. So in this situation, it's really important that the emphasis is you need inputs and processes, and they have an ability to contribute. Now, the inputs and the processes no longer need to have the ability to create outputs. Instead, they merely need to have the ability to contribute to the creation of outputs. And that's a very important distinction. So in the past, your input and your process had to create an output. At this stage, new definition, it has to contribute to the creation of an output. So in a way, it makes it a bit broader. So that's the first thing. Also, so if you look at inputs and processes no longer need the ability to create these outputs. Instead, they just have to contribute to the creation of these outputs. So the intellectual capacity of an organized workforce, having the necessary skills and experience in following rules and conventions, may provide the necessary processes applied to inputs to create outputs. So the fact that I've got an organized workforce and they've got certain skills and experience means that there is an ability to create these outputs. So the focus on outputs is on returns from goods and services, investment incomes, and other income. So that's similar to the change that was made to the definition of a business. So at least it lines up. There's some consistency, which is always good. So I thought I'll look at an example to illustrate. So in our example, we said Multinational Biotech Limited, MBL, purchases small vaccine researcher company. And the operation of this small vaccine researcher company include the following. In process research and development of various vaccines, including a COVID-19 vaccine. They do not yet have completed vaccines with regulatory approval and currently does not have any revenue from the sale or licensing of any of these vaccines. Scientists and other clinical staff, they do have scientists and other clinical staff with the knowledge and the skills to perform the R&D activities, including the clinical trials. And then they also have management staff with experience in operating a biotech. They do not have documented operational processes or strategic management processes, but they've got staff, scientists, management that have the skill set. Plant and equipment, including corporate headquarters, research laboratories, research equipment, consumables, that are used in the research process, they have all of that. And then the question, has MBL acquired any processes when it purchased the small vaccine research company that are capable of being applied to inputs to create outputs? And we've given you three options to have a think about based on what we've just discussed. Is it no? They do not have documented operational or strategic management processes in place, so the answer is no. Or do we say yes? They have an organized workforce consisting of highly skilled scientific staff, etc. Or the other option, they do not have any revenue, therefore they cannot have any processes in place. So 2 no's, quite strong no's, and then 1 yes, which is really focused on the fact that they've got an organized workforce that has the necessary skills and experience that is capable of being applied to create these outputs. So 3 ideas to think about. And then the answer is the option 2, and that's part of this amendment. It's just trying to flag to you how the thinking is now changed as a result of this amendment. By the way, the answers are not included in the slides that I've sent out this morning. However, after today's webinar, a recording will be sent out, or a link to a recording, as well as the slides that include all the answers. So don't worry about that. Now, the 3rd amendment is still around this process, and that is that a business needs a minimum of an input and a substantive process. So it's not just an input and a process. They've said, hang on, this process has to be a substantive process. So an input plus a substantive process that significantly contribute to the ability to create outputs. That is what we need, all right? So that yellow block changes from a process to a substantive process. So just an example, maybe to talk about that. So Logistic and Transport Co. purchases a new motor vehicle. Now, the motor vehicle will be used as part of its fleet of motor vehicles that provides transport services for customers. And Logistic and Transport Co. will employ a new driver to use the motor vehicle. And in this situation, has Logistics and Transport Co. acquired a substantive process with the acquisition of the motor vehicle? Note that the input acquired is the motor vehicle. We've bought a motor vehicle. Do you believe we've also acquired a substantive process? So the one option is there's no substantive process that's been acquired, and the other option is the acquisition of the motor vehicle is critical to the ability of Logistic and Transport Co. to generate revenue, and therefore we've got a substantive process. So what do you think? So it's an input plus a substantive process. It cannot only be an input. And the answer here is no. If you just get the vehicle, which is a critical input, absolutely, that's not good enough. That's just an asset. We also need with it a substantive process. So that's really important. Now, I can hear you ask, I think you're screaming at the stage, and I'm hearing it. How do we know whether a process is substantive or not? All right, so that's the next step in this process. Now, to assess whether an acquired process is substantive or not, there's a threshold question. And the first question, or that threshold question, is, does the set of activities and assets have outputs at the acquisition date? No or yes, because it leads you down a path of different things to consider. So the activities and the assets, do they already have outputs at acquisition date or not? Because remember, it's not important to have outputs at acquisition date. We'd only need inputs and substantive processes that have an ability to contribute to outputs in future. We don't need the outputs at the moment. So if you say no, there are no outputs at the acquisition date, we look at an analysis of a set of activities and assets that do not have outputs. We've got a separate set of questions that we look at. And if you say yes, different set of questions. So I've got 2 separate slides to look at those. So in this one, there's no outputs at the acquisition dates. And the things you have to consider is the acquired process critical to the ability to develop or convert an acquired input into outputs? If you say yes, another question, do the inputs acquired include an organized workforce that is highly skilled, knowledgeable, or experienced to perform this acquired process? If you say yes, you say, do the inputs acquired include other inputs that the organized workforce could develop or convert into outputs? So it's a series of questions, and you say yes to all of these. You would say, okay, this acquired process is substantive. Because if we put all of these things together, we could contribute to an output in future, although at the moment there's no output. The other alternative would be, you've said, hang on, we have acquired activities and assets that has outputs at the acquisition date. Now, again, this is interesting. There's two kind of approaches to tackle this scenario. Now, the one approach, you can start at the bottom and work up to the middle. Do we have a substantive process or not? You can start by saying, does the acquired process significantly contribute to this ability to continue producing outputs? If you say yes, and is this acquired process considered scarce or unique or cannot be replaced without significant cost, effort, delay in the ability to continue producing the outputs? So we're currently producing outputs. How critical is this to that process? The other approach you could follow from the top down is the acquired process critical to the entity's ability to continue producing the outputs? If you say yes, do the inputs acquired include an organized workforce that has skills, knowledge, and experience to perform that process? So there's two different approaches to assess whether you can continue to create these outputs going forward. So we've got a bit of an example that we've included. I think at this stage, I'm happy to leave this example for you to have a look at. It's, it's based on our a vaccine research company, similar fact pattern. And I think what we've added here, has MBL acquired a substantive process with this acquisition? So really that set of processes, the organized workforce, is it critical to the ability to develop or convert the acquired inputs into outputs? Or do you say no, we acquired a set of processes that is critical, and while an organized workforce was acquired, MBL did not acquire any other inputs that the organized workforce could convert into output. So two different approaches. So what do you think? And in our situation, we've said yes. We've acquired a set of processes that is critical. The inputs that we've acquired include an organized workforce with these skills, and it also has other inputs that the organized workforce could convert into outputs, which are in the process of R&D. And therefore, we believe, we've got an input, we've got substantive processes, and therefore we've got a business. Now, Amendment 5, I think, is where the rubber hits the road a little bit. It's a really complex area. They've introduced an optional concentration test, and it's important to put emphasis on the word optional. But I won't steal Ashley's thunder. Ashley, I'll hand over to you to look at the optional concentration test.
Great, thanks, Aletta. All right, so for the optional concentration test, it's basically a shortcut way of concluding that the acquisition is not a business without having to conduct the detailed assessment that we've just gone through. So implying this test, the acquirer asks the question whether substantially all of the fair value of the gross assets acquired are concentrated in a single identifiable asset or group of similar identifiable assets. So if the answer to this question is yes, then the set of activities and assets acquired should be accounted for as an asset acquisition. However, if the test is not met, then the acquirer needs to perform the normal assessment as set out in paragraphs B8 to B12D in order to determine if the acquisition should be accounted for as a business combination or an asset acquisition. And as Aletta said, it's important to note that it is an optional test and can be applied to some acquisitions and not others. So it's an election for each transaction. Looking at this in further detail, so when the purchaser applies the concentration test, it needs to consider the additional guidance included in paragraph B7B of the standard, which states that when the purchaser applies the concentration test, gross assets acquired shall exclude cash, deferred tax assets and goodwill resulting from the effects of DTLs. Also, the fair value of the gross assets acquired shall include any consideration transferred in excess of the fair value of net identifiable assets acquired. The fair value of the gross assets may normally be determined as the total obtained by adding the fair value of the consideration transferred, plus the fair value of any non-controlling interest and the fair value of any previously held interest to the fair value of the liabilities assumed other than DTLs, and then excluding the items identified in the bullet point above. However, if the fair value of the gross assets acquired is more than that total, a more precise calculation may sometimes be needed. Another point to consider is single identifiable asset shall include any asset or group of assets that would be recognised and measured as a single identifiable asset in a business combination. If a tangible asset is attached to and cannot be physically removed and used separately from another tangible asset without incurring significant cost or significant reduction in utility or fair value to either, then those assets shall be considered a single identifiable asset. And when assessing whether the assets are similar, an entity shall consider the nature of each asset and the risks associated with managing and creating outputs from the assets. So when the entity applies the concentration test, the standard is clear that the following groups of assets should not be considered similar assets: a tangible asset and an intangible asset, tangible assets that are in different classes, intangible assets in different classes, a financial asset and a non-financial asset, non-financial assets in different classes, and identifiable assets that are within the same class but have significantly different risk characteristics.
Mm.
So to look at this in an example, the background facts for the example here is that Small Investor Co has purchased a portfolio of 20 four-bedroom properties. Each house is in the same geographic area, includes land, the house and property improvements, has a different layout, has a separate rental agreement in place. However, the demographic of the tenants is similar. The fair value of the consideration paid is the aggregate fair value of each of the 20 four-bedroom houses acquired. And assume that any risk associated with the properties in the portfolio is not significantly different, and there were no employees, other assets, or any other activities were transferred to Small Investor Co. So the question is, assuming that Small Investor Co elects to apply the concentration test, do you think the concentration test has been met? So here we have two options. Do you think the answer is yes, the concentration test is met because substantially all of the fair value of the gross assets acquired is concentrated on a group of similar identifiable assets? Or option two, no, because while substantially all of the fair value of the gross assets acquired is concentrated on a group of similar assets, the concentration test cannot be met because the land and buildings are separate tangible assets. So the answer for this example is that Small Investor Co would determine that the concentration test has been met, so option one, because substantially all of the fair value of the 20 properties acquired is concentrated in a group of similar identifiable assets. This is because each of the 20 houses is considered to be a single identifiable asset because the buildings, the related property improvements is attached to the land and cannot be separated from it without enduring significant costs. And the building and the lease that is in place at the date of acquisition would be considered a single identifiable asset because they would be recognised and measured as a single asset in a business combination. Also, the group of 20 houses are considered to be a group of similar identifiable assets because they are similar in nature, and the risk associated with managing each house and creating outputs is not considered to be significantly different because of the location in a similar geographic area and because they are rented to a similar demographic. So to take this example further, we assume all the facts in example 4 are the same, but the following additional information also applies. As part of the portfolio acquisition, Small Investor Co. also purchased a small shopping centre that includes a supermarket and 5 other retail shops that are currently leased for use as a cafe, bakery, greengrocer, butcher and pharmacy. Security, cleaning and maintenance of the common areas of the shopping centre is outsourced to third parties. And in this example, the aggregate fair value of the consideration paid for the portfolio, being the 24 bedroom properties plus the shopping centre, is 1% less than the aggregate fair value of each of the separate properties. So the question here, assuming that Small Investor Co. again elects to apply the concentration test, do you think the concentration test has been met? Again, we have 2 options. So option 1, yes, because substantially all of the fair value of the gross assets acquired is concentrated on a group of similar identifiable assets. Or option 2 being no, substantially all the fair value of the gross assets acquired. The concentration test cannot be met because the risks associated with managing the group of the properties and the retail property are significantly different. So the answer for this example is option 2. So IFRS 3 is clear that Small Investor Co. is unable to apply the concentration test to the portfolio of assets acquired, as the risks associated with managing and creating outputs from the assets are different. In this case, the risks associated with managing the retail tenants in the shopping centre and the families renting the houses would be significantly different, so the concentration test cannot be applied. Small Investor Co. will need to assess whether the transaction is a business combination or an asset acquisition in accordance with the previous requirements that have been discussed. So looking at the normal procedures to determine whether there is a business combination or an asset acquisition. So option 1 would be asset acquisition. The acquisition is an asset acquisition because it does not have any substantive processes. Or option 2, it's a business combination with input, substantive processes and outputs. And in this case, it is likely that Small Investor Co. would determine that the acquisition of the property portfolio would be an asset acquisition because the portfolio acquisition does not include the acquisition of a substantive process, as the letter previously went through. So this is because while the portfolio acquisition includes outputs being rent, at the date of acquisition, it did not acquire any substantive processes. This is because Small Investor Co. did not acquire an organised workforce with the necessary skill, knowledge or experience to perform processes necessary to generate outputs. And also because the processes that are performed in the shopping centre, such as cleaning, security and maintenance, are all outsourced and will be considered ancillary processes within the context of all processes that would be required to create the output. So that's it for these examples. Kevin will go through another example. Over to you, Kevin.
Thanks, Ashley. And I have to say, at this point, when I was going through the material, and it even happened again this morning, I thought to myself, what's going on here? Because every time I come back to this amendment, I think to myself, what were they trying to do? And I think when we stand back, you need to look at the concentration test together with the change in definition of the business. They're actually all integrated changes. They weren't made individually. And it is obvious that they're targeting entities who haven't yet established an integrated going concern type entity. And just a bit of background, this really started, God, it feels like 10 years ago since I started talking about this, but it has been a while. They were actually targeting the pharmaceutical companies who were developing molecules into patents, and COVID is such a great example of that because, yes, you might be looking to try and research something, but at what point does that become an integrated set of activities? And you can throw all the highly skilled professionals at research and development, but until they're organized and they're working towards the common goal of putting it all together, they're not really a business yet. And that's really what the key is here. And I keep just wanting to say integrated, organized to the workforce example that we keep going on about. The organized word is the important word there because they are organized to work towards the common goal of developing the COVID vaccine or so forth. And it's the same here, really. In the examples that Ashley just did, we're trying to give you different examples in different industries where you're going to see this, because the idea is substantive process. That thing that has moved the input into an integrated set of activities to achieve the output. But the reason why I always say to myself, what's going on here, is because the two examples that Ashley did appear to give different answers depending on which route you go. And unless I've dropped off the side of a hill this morning, in the first example of 5A, we said that the concentration test was not met. Is that right, Ashley? Just remind me if I got that wrong. And so we're saying that substantially all the fair value is, it cannot be met because the groups associated with managing the group and the retail are significantly different. So I guess the question is, well, what does that mean? Are we acquiring a business or are we acquiring an asset? And Letta, how do you read that? It is a trick question.
Yeah,
Because it
Kevin,
reads
so
as if it's an asset acquisition. Sorry,
yeah,
as a business combination.
yeah, I think the interesting thing to remember is maybe what Ashley started with, and that is you could always do the normal assessment, whether this is an asset acquisition or a business combination. The idea is to provide this kind of shortcut assessment.
That's right.
To get out of business combination. There's no shortcut into business combination. There's just a shortcut out. And I think that's the way I look at it. If you can say that there's this concentration, then you're clearly out of IFRS 3, don't do the rest of the assessment. However, if you can't use the shortcut out, we're not saying it is a business combination yet. We're saying now you have to do the hard work.
That's right. And that's the key to this is I'm not necessarily sure this is a shortcut. I think the standard setter has done a terrible job at selling what they were trying to do here, because what they were really trying to do was provide an assessment option that focused on different factors, because clearly the way it's always been done since IFRS 3 came out was based on processes, inputs, and the existence or opportunity of outputs. But that's not always easy to do. And the shortcut is actually trying to say, and I'm coming back to my negotiation comment right at the beginning, sometimes you negotiate based on risk and on value driver. In other words, the valuation or the fair value. So you can see in the value you're negotiating, and you can see the risks that are being negotiated already, whether you've got a business combination or an asset acquisition, which is why it's an optional test, because you choose that option if you could see it almost clearly. But if it fails, you drop out and you go back to the process. In other words, you must go and check your answer. And that's the key to the standard, is the optional concentration test does not take you to the answer. A failure of the optional concentration test takes you to the full assessment. So in a way, it's kind of like a double-edged sword, because a failure on the test means you've got to go do the work on the process, and why don't you just go there, to begin with. So that's a really key part of this, and that's why I always keep looking at it, because the question really is, what are we doing here? Why is this optional concentration test? And it's because you can sometimes see in value and risk what the answer is starting to be even before you've done process assessment, and it was meant to shortcut that process. It is not meant to make it easier to apply IFRS 3 or drop out of IFRS 3, but that is what a lot of people in the industry is starting to see it as. And that's my lessons learned. And I will come back to the lessons learned just after example 6, and let's just quickly run through it. But one of the biggest lessons I learned in the first round of this was that the particular client I was working with chose to do the optional concentration test because they were trying to achieve an outcome. They didn't want it to be a business combination, but that's not what the optional concentration test is. It doesn't change the answer. It just helps you get to the answer either quicker or with more certainty. And if that's the key takeaway today, I'd just like to kind of put that on you, is the optional concentration test, it doesn't change the answer. It's meant to give you a different a factor-driven answer of what should just be confirmed with a full assessment if you actually had to go down that road. So having a look at example 6, it's another property. We've got Bazaar Centres, the largest operator of shopping centres. They've got 450 specialty retail shops, and I'm just paraphrasing here. There's individual leases and a workforce of 50 people that are responsible for operating, information desk, cleaning, and you should start to see where I'm heading here, because this sounds very much like an integrated set of activities. You can't assume that that is true, but it's starting to sound that way. They've got documented processes and systems. In other words, this retail type center doesn't just operate by itself. The asset needs all this other stuff to work and to generate its, returns and so forth. And then the consideration paid was 415 million. And I hope I haven't actually left out any of the key facts there, but let's see. We'll see now in the answer. Now, the reason why we've done this is because sometimes you actually need to do the fair value to see if there is a concentration. And I think Ashley said it right at the beginning of her section, where she said sometimes, and the standard does say that, you've got to go and actually look at the fair value or to test your answer in the optional concentration test. And in this case, and you can work through this yourself as well, we've got land and building, and it's going to be cash, not much of it, but there will be there's going to be financial liabilities, because clearly the more activity you have around an input, you're going to have more resultant assets and liabilities that look like a business is happening, because that's what they do. They generate cash, and cash is king. That's what we're trying to do here. In this case, the fair value of the gross assets acquired were 516 million. Now, that's applying the rule that Ashley touched on, which was grouping assets into essentially their similarities. Clearly, we're buying a retail type center here, and so we start to add things together. And I'm going to say to you that's probably the land, building, and the identifying intangibles that give me the number. I think been missing 2, and I can't recall where, but we'll take it on face value. We've added a couple of things on there. So in this scenario, the reason why they're doing this is applying the optional concentration test is not determinative sometimes without the numbers. Sometimes you actually have to go test whether there is the concentration in the test. And this can be particularly useful when you're negotiating other things in the arrangement. So restraint of trade agreements, the classic example. These are the sorts of clauses that end up in merger and acquisition type arrangements, which appear standard or industry specific, and often the clients will say to you, oh, everybody has that in their contract. But that often creates assets, and it means it takes it away from the concentration of the assets, because what you're really aiming for here is a concentration in the retail center. That's what you're looking for. But the moment you start to have other things start to emerge, it starts to dilute the concentration argument. And I'm specifically referring to restraint, because in a recent example, it was a software company that we had, and clearly the software and the startup arrangement, that was the asset they were trying to acquire. But they ended up taking on the employees, and they didn't really need 5 of them. There were 5 or 6 employees. They didn't need 5 of them, but they needed one of them who was the owner and the technology manager. So clearly he had integrated himself into the development of the assets, and that integration started to occur. And not only did they keep him on for 6 or 8 months after the acquisition to keep the software going or the development going, but they also restrained him when he left the company for something like 18 or 24 months. So they started to create a scenario where they started to protect their business, even in the way they negotiated his exit. And those are the sorts of things you need to keep in mind when you're applying the optional concentration tests, and this can often be indicated through this type of arrangement. Let's see if we can move on to the next slide. I know we have gone over time a little bit. So the question here is, has the concentration test been met? Now, you might have to go back and actually look through this one yourself to work the numbers out, and I encourage you to do that. We're not going to have time to work that through. But if we move on to the next slide, and this is now the option 1 is, yes, it has been met because they substantially, all of the fair values have been actually concentrated into a single identifier assets, and we can prove that. We've got some numbers that are worked that will come up on the next slide, and you can go work this out yourself. And something like 98% of the assets do actually end up being in the asset, which kind of implies, well, you know, has been met. Do we have a business combination, or don't we have a business combination, and we need to keep going? But the concentration test has been met because really it's only the asset. Everything else is essentially not there. Yes, there's an organized workforce, and they're doing a lot of things, but the asset values are all sitting in the shopping center, and there you can see the 516, how you get that. So the question is, if BC elects not to apply the concentration test and goes straight to the processes, what's going to happen? Now, remember, if the concentration test failed, they would have gone here anyhow. And that's the really important point. So should BC account for the acquisition as a business combination or as asset acquisition when applying the assessment? Now, we've got 2 options here, and I'm going to encourage you to think about it carefully. The acquisition is a business combination with inputs, processes, and outputs. Or the acquisition is not a business combination because it's got the inputs, but the processes are not considered substantive because the ability to implement processes from other shopping centers can generate the income. So now this is looking at risks. We're going back to Ashley's point again about the risks, because clearly it's starting to head us towards, well, yes, you've got all these activities and processes and so forth. Are they unique? Is there different risk profiles in managing them? And you can start to see the judgment oozing into this. And I know that some of you are going to use words like, oh, I can manipulate the result. That's not really true. Pointing out again that you've got to follow the processes through and realize that the concentration test is optional, and also on a failure takes you to the full assessment to check whether you've come out. Now, what's going to happen here if we had not applied the concentration test and gone straight to the full assessment? Well, we would have actually got an option 1 in this case, which is the business combination. Now that looks out of sync again, doesn't it? And I'm just going to let that settle for a while, because the optional concentration test does give you, in some scenarios, a way to present an asset acquisition that would otherwise be based on processes. So it's not really an or. It's kind of an and, because what this is trying to give you the option to prove is that a business combination through the optional concentration test actually gets you to validate the answer not only on processes, but also on negotiation of risk factors and value proposition. So it's a true business negotiated outcome. So that's something to take away and think about. I would say that the biggest question you're going to give to Ashley, myself, and Alessi, if you give us a call, is probably whether you apply this test. not how to apply the test. That's probably the biggest advisory we could give you going forward, because it takes you down a path that essentially is trying to validate factor-driven risk, value, and processes in a way. I hope that's settled in. There's a lot of detail in those examples. We did kind of work through them in a quick way. It is difficult to understand some of that when you read the standard the first time and the second time and the third time in some cases. And I encourage you to actually, if you have nothing to do on a Saturday night, take the basis of conclusion and understand what they were trying to do here, because it links very much to business process and in business process in negotiating transactions. Not about the processes acquired, about why did you do the transaction and what were you trying to achieve. So it is trying to link to the actual day-to-day, management and leadership of an organization and how it links to business strategy. It is actually trying to link it to there. It's not trying to just come at this from left field. But it is important. Yes, sorry, Alexa.
This kind of links into a number of webinars that we've scheduled from March onwards, where we're going to discuss with our attendees situations where there are options available to organizations to think about what are my options here. And this is a really good example. I've got the option to do this concentration test. And for this example 6, if I follow that option, I have an asset acquisition, no goodwill, no fair value of my assets. However, if I use the other option, and that is to not do the optional concentration test and do the normal assessment, I will end up with a business combination with goodwill, etc. So this optional concentration test is giving us 2 potential outcomes. And I mean, I suspect that people will do both and then decide the outcome that they would want to communicate and reflect in their financials. This is what it's doing, right?
Yes, it is. And look, very, very interestingly, if you had to go back to example 5A, where we put the, in this example 6, where we did the original optional concentration, I'm not so sure I actually agree with the answer, but it was done in such a way by the standard setters to demonstrate a concept, because I actually think interpreting organized and the organization around that particular workforce would have been important. I also think, to be honest, and I'm going to be quite controversial here, I actually think there was an asset acquisition and a business combination. There was a shopping center and there were individual properties, but it's going to be fact specific. This was just a made up example. This was not a reality based example. So facts and circumstances drive this. I think you can get to the same answer under the 2 in this case, but it was designed to show you what it's trying to do. That's what it was designed to do. So please don't take away from this that this is all up in the air and crazy. What this is trying to do is that there is judgment here, and it's going to be significant judgment. And if you do have a scenario like this, I would say that will end up being disclosed as a significant judgment in your financials. So there's a lot going on here that links to business strategy. Letra?
Yeah. So Kevin, the interesting thing for me here is sometimes, whether you do the optional concentration test or the normal assessment, the answer will be exactly the same. However, sometimes when you do the optional concentration test and the normal assessment, the answer will be different. And therefore, you've got a choice whether you want to do the optional test or not, depending on the outcome. So this is, this is powerful stuff. It's powerful stuff we're talking about.
I would say, and I'm also going to be controversial, if you do get 2 different answers, I'd say I'd go back and check your presuppositions and judgment, because there really shouldn't be that. It shouldn't end up that way. They're not being designed to end up there. But I think it is trying to acknowledge that there's more than just process-driven business combination assessments. No one negotiates a transaction like that. And also, let's face it, they're making an accounting standard that is meant to cover everybody principally, but not every transaction is the same. And that is really important, and that will be industry specific. Now, I am going to cut the discussion off there, because we've gone a bit over time. We've got a lot to say, obviously. But in the last few slides there, we've given you some examples on the differences between asset acquisition in the numbers. Now, let's just quickly go back to that one. go and work through this if you're about to enter into a business combination, because this is a slide that essentially summarizes some of the big differences between the two. And it's going to be things like goodwill, absolutely. Deferred tax on identified intangible assets that are acquired, like customer lists, will be different. And one thing that keeps coming at me is contingent consideration. Not so sure this drags it out, because these examples don't have contingent consideration, but in an asset acquisition, you don't get to recognize the contingent consideration, but in a business combination, you do at fair value. And that significantly changes the liability part of your balance sheet. It also means that subsequent estimate changes to contingent consideration change the subsequent profit and loss of your recently acquired assets or business. And so there's a little structuring to be done there as well. So in terms of lessons learned, and I'll hand back to Aletta after this slide. Now, these were just some ramblings I put together this morning. This is not a quick or simple way out of IFRS 3. This is what I call a value or risk-based assessment and an inputs process and outputs assessment, but it's optional. And they should kind of align. Kind of being the optional operative word. Timing is also important. Now, we kind of bolted across the fair value measurements, but this is something that you want to take as managers into account. Business combination accounting gives you this provisional accounting allowance of 12 months after the acquisition to kind of firm up your fair value measurements. But sometimes you need those fair value measurements to decide whether you've got a business combination if you go down the optional concentration test. So before you go down the route of the optional concentration test, make sure you've thought about whether you're going to need some values to support your test, which may actually means you've got to put some values to it right at the start before you've even put numbers onto your trial balance. And that can probably change the timing of when you would ordinarily have engaged a valuer to do your purchase price allocation. Just something to think about. And then the other thing is, be careful of standard, or what I call industry usual merger and acquisition type contracts, because they often introduce more assets or rights onto an accounting, which starts to move the concentration away from a single group of assets or a single asset. And sometimes you get other intangibles emerging, like restraint of trade intangibles, which I know is controversial in the valuation world, and whether you actually have an asset there. But if you are negotiating the former owner into an 18-month countrywide restraint, which is what happened in my software example, my software company example, it ended up being a pretty big asset, and there was no longer a concentration because it wasn't just software they had anymore. There was restraint assets as well. And that started to change the outcome of the concentration test. And so they had to go back to their full process assessment in that case. All right, I will, Aletta, hand that back to you with 2 minutes to go before 12:30 on the East Coast.
Thank you very much, Kevin and Ashley. So I think for our first webinar back, we kind of really blew out the time. We got all excited about all the R&D cash Travis is going to get us and our clients. And this amendment, the more we talk about it, the more we look at it, the more we consider the examples. It's not an easy one, but I do like the exciting aspect that it brings to our advisory clients. And we'll touch back on that in our webinars in March onwards. Next month, we'll be looking at an oldie but a goodie, and that is applying IFRS 1 or AASB 1 to transition to general purpose financial statements. So if you were to dust off the old IFRS 1, which we used way back when we transitioned in 2005 in Australia, if you now transition from special purpose to general purpose, we have to go back to IFRS 1 quite often. So we'll look at that in great detail. I think that's an important one. And this is the webinar that I've talked about earlier. In March and in April, we're going to look at a selection of accounting policies, appropriate accounting policies. And we want to explain, do we understand the basic alternatives that are available? So sometimes you are forced down a particular accounting outcome based on facts and circumstances. And in other situations, I would say sometimes we think in rare situations, but it's not that rare. In other situations, you've got choices available. And that's where it's a good idea to model the impact now and in future, and clearly think what the alternatives and the on your financials would be now and in future. Sometimes we just look at now, sometimes not at just at future. Sometimes we go for the lowest risk, but from an advisory perspective, we want to look at commercial reality. So the March and also the April one, where we want to add on to the selection of the appropriate accounting policies, another little bit of a nuance, and that is aligning your selection with your organization's stage of life. So that's just a few of our webinars up and coming. I know a lot of you are in the midst of half-year audits, or maybe your 31 December annual audits. If you're looking for some assistance to be audit ready, please feel free to contact us, and just a little bit of a spiel there on how we can help you to be audit ready. At BDO, we've got 4 IFRS advisory partners. We also have Clark Gerald based in Brisbane that you can contact, and this is our team of 16 that can help you with being audit ready, IFRS advice, and please feel free to reach out to any of us. Finally, I would like to say thank you very much to Kevin and Ashley for joining me today. It was great fun, as always. I'm looking forward to our February webinar already, and we'll try and stick to the time. We'll try, but we're all very passionate, so we get slightly overexcited. Please excuse us. I hope you have a lovely day, a lovely month, and we'll speak again in February. Thank you very much.
Goodbye, everybody. Goodbye, Ashley and Alyssa.
Bye.
Bye.